My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. So what I'm gonna do is I'm gonna look at individual portfolios that people are sending to me in my email. So you can do the same thing if you wanna check out the email in the description below. You can send in your portfolio and I will review it on a future video like this video today. And so really the goal of the video is to just kind of give my perspective and opinion on some of the subscribers, portfolios and some of the things that I've kind of, would consider if I was in their situation. Man, these last couple of weeks have been pretty intense here in the stock market. If I look at my portfolio here in M1 Finance, if I just expand it all the way out, I can see, okay, the portfolio has gone up pretty nicely. But if I look back here, on the performance on Friday, pretty red. If I look over the last week, also pretty red, down $10,000. I can't even imagine, like $10,000, almost $11,000. That's like a lot of Xboxes and a lot of PlayStations. When I was a kid, I would always equate things, if they were expensive, by how many Nintendo 64s I could buy. And so that's a hell of a lot of Nintendo 64s that I could have bought, with $11,000. But, with my portfolio, I have it on autopilot. I'm dollar cost averaging. I'm really, just taking the boring approach of dollar cost averaging into the portfolio every single week. And really the thing that I'm focused on is really making sure that I'm keeping my day job. As long as I'm keeping my day job, keeping my expenses low, I personally welcome this type of activity in the market. I really like seeing volatility. I like seeing the prices of my holdings, my companies go down so that I can increase my yield on cost. The one thing that you do want to be careful of is if you recognize that you're an emotional investor and you're very, you get influenced very easily, you're very impressionable, be very careful with what media you're watching, whether it be here on the news, on CNBC, your friends, whatever. There's a lot of clickbait going on right now on YouTube. I can really only speak for YouTube for the most part, but like you go and you Google anything around the stock market, you're going to get like these scary thumbnails. You're going to get, you're going to read things that the market's going to drop 50%, the market's going to drop 70%. Really the big thing that I'm saying with this is really try to curb your emotions, try to understand that there's a lot of fear mongering going on, and just keep your cool. If you're dollar cost averaging, this is a great time to be averaging down into the portfolio. In today's Review My Pie, we're going to review 4 subscriber portfolios. The first is from a 31-year-old here in the United States. The second, a 30-year-old from Belgium. The third, a 19-year-old from the United States. And then the fourth, a 42-year-old from the United States. And if you're not familiar with where Belgium is a European country right in between France and Germany. There you go, a little geography lesson for the day. All right, cool. So there's going to be timestamps in the description of this video, as well as portfolio links in the description. And as always, everybody, I'm not a financial advisor. Don't take what I'm saying as financial advice. It's just merely for your entertainment. And as always, everybody, I don't pre-read the emails. I don't pre-review the portfolios before making this video. I'm doing it in real time just so that I can make it as authentic as I possibly can. But as I said, the market is really crazy right now. There's a lot of fear going on, a lot of anxiety. Emotions are high. Try to keep your cool. If you're a new investor, understand that market volatility is normal. And it probably, if you're a new investor, you're probably feeling a little like this.
Emotional damage.
Oh my gosh. Oh man. All righty, here we go. The first portfolio is from Jordan. He writes, "Hi Jake, my name is Jordan. My wife and I started watching your videos and I want to say that you really have great and informative videos." Thank you so much, Jordan. I appreciate you writing that. We also watch other content creators like Our Rich Journey, Meet Kevin, and Gen X Dividend Investing, but I can say that we can really relate to you the most. Background, I've been working as a nurse for 8 years now here in the US, and our goal is to become financially independent by the age of 50. I really don't want to work as a nurse until, I'm 50 or 60 years old. We don't have kids yet, but planning to have them in the next few years. I have a Roth IRA from Fidelity, but I also have made some mistakes in buying, hype stocks and not so reliable companies. Here are some companies that I bought in that account: Neo, GSAT, OEG, Sundial, AITX. Currently, I'm down 19K on that portfolio. I know it hurts a lot. I've learned my lesson and I don't want to repeat the same mistakes, and this time I want to do this right. I opened a taxable account and my wife opened her Roth in M1. Next year I'm going to open a Roth in M1 too, since I have maxed out my contributions for this year in my Roth and Fidelity. Like you, we want to achieve being financially independent, so we started watching your videos. I'm 31 years old and my wife is 30 years old. We both recently made an M1 finance account. We're both new to dividend investing and would appreciate your thoughts on our portfolio. Thank you. Well, Jordan, thank you so much. I really appreciate the kind words. The other YouTubers that you mentioned here, Our Rich Journey, Aman and Christina, are amazing. They've helped me so much when it comes to understanding the FIRE movement and really understanding, especially with the real estate part. Like, I watched a video from Aman and Christina, how they turbocharged their FIRE journey through real estate. It was that's really what sparked my interest in investing into real estate, as well as with Meet Kevin. Meet Kevin's content lately, I don't know. I talked about clickbait earlier. He's the king of clickbait, but he provides a lot of entertainment and value. But I got a lot of value out of his older videos. Gen X dividend investing is amazing. He's great. Like, he's living the FIRE dream right now as a dividend investor. He makes really great content here on YouTube. When it comes to your situation, you've been a nurse for 8 years. My mom was a respiratory therapist for her entire career. And I got to experience that as, from the other side, watching her and, a lot of the stress that she had to go through. It's a very demanding job. And my mom actually retired earlier as well. She retired at 55. And I remember hearing many stories of, she got a lot of, fulfillment out of the job, but it was exhausting. It's a lot of work. It's very demanding. And a lot of things have changed since she was working in the hospital than, today. But I definitely can understand where you're coming from. I like the fact that you're focusing on, your taxable accounts. You're taking advantage of a Roth IRA and, understanding the nuances when it comes to that. I think everyone, when it comes to the 19K down, you're probably even down more today. I'm recording this video on January 23rd. I can only imagine how far, depending on when you bought the companies, I'm assuming, but I can only imagine how far, in the red you are now, given how beaten up these growth stocks have been. I think, when you're now looking to go into dividend investing, it's always, better late than never, right? Like, I've invested into companies that went bankrupt. I've invested into penny stocks. We've all been there, right? As a kid, we have to touch the stove to learn that the stove is hot and not do it, right? And that's why a lot of the things that I'm talking about on my channel are just guidelines to protect you as an investor and things to be aware of, right? And that's why I love following the core and satellite approach to investing. That's why I love, having limits on the, amount of exposure that I have in individual companies and individual sectors and all of that stuff. And that's why I think, why most investors would be better off investing into low fee index funds. I think, especially if you're a new investor, I believe that you should skew heavier towards low fee index funds in the beginning. And as you learn more, you can venture off into individual stocks. All right, let's take a look at your portfolio. Your portfolio is up a healthy amount since May of 2020. It looks like you may have a company here that went IPO. You have a very low expense ratio. You have a 3% dividend yield, 42 holdings. It's a manageable amount. If this is a passion of yours, 42 holdings is manageable. I would say it's probably on the higher end if you just started. So that's something to be aware of. I'm glad that it's not like 70 or 80. I probably can imagine you probably cutting down, some of these holdings as you learn more about dividend investing. The important thing is if you're in your early 30s and you're looking to reach FIRE by the age of 50, that's 20 years. So it's important that you understand how compounding works. So if you're a new follower or subscriber of the channel, go back and watch some of my videos where I talk about compound interest. I talk about the rule of 72. Because that's really the key thing that you have to understand when you're approaching dividend investing, because there's many different ways that you can approach dividend investing. So let's take a look at your slices here. You have your core at 25%. This is probably like your highest conviction stocks. You got real estate at 15. You mentioned that you have a Roth IRA. Why not put the majority of your real estate in your Roth IRA and save on the extra taxes that comes with that? So it may be something to consider. You have to understand that you're not going to have access to your Roth IRA until you're 59 and a half, right? So maybe that can be part of your overall exposure. But if you're investing into a Roth IRA anyways, my opinion, you'd be better off having this in your tax advantage account, unless you're investing into really high growth real estate, like, cell towers and data centers. So like, for example, I wouldn't have a retail REIT in your taxable account if you have a Roth IRA anyways, right? And you kind of are looking to retire around that your 60 or 59 age point. You got growth, technology, probably some overlap here in that sense. Energy, I don't like energy. We'll see what's in there. At 7% with a 20-year time horizon is what I'm saying. Healthcare at 5%, communications, banking, consumer staples, cyclical. Okay, so this is what I would recommend. You said you're new to investing. I would recommend increasing the staples, because you probably know these companies better than you know energy companies or healthcare companies. This is what I say to everybody that's new to dividend investing. It's okay to not have your perfect slice, break up in the beginning. I always recommend investing into companies. If you're going to invest in individual companies, not index funds, invest into businesses that you're a consumer of, right? Invest into Pepsi, invest into Coca-Cola, invest into Procter & Gamble, Kimberly-Clark, those type of companies, those businesses that you're a consumer of, because you understand them. So that's the very first thing. All right, so let's take a look at your first slice. You got SCHG, very good, SCHD, QYLD, and JEPI. Okay, I actually kind of like this. I like this except for QYLD. I made an entire video on QYLD. You would be better off holding QQQ with a 20-year time horizon. QYLD is a great cover call ETF. I really like the ETF with a shorter time horizon. If you're looking to, even if you're reinvesting the dividend for 5+ years, in my opinion, in most cases, you would be better off holding QQQ and then transitioning out of QQQ, selling it, and then buying QYLD, right? You get that? You reinvest and you let QQQ, the NASDAQ ETF, compound for 20 years, and then you sell it, right? Now with JEPI, I believe JEPI is kind of a unicorn when it comes to cover call ETFs. I think this one is fine. I love SCHD. I really like SCHD, but QYLD, I believe that this is, in most cases, a mistake given your time horizon. So something to review. Real estate, what do you got in here? SPG, do not like it. I mean, I think it's a great REIT, but not for a 20-year time horizon. I just don't know. Not the biggest fan. Realty Income, yeah, it's great. Main Street, yeah, it's fine. VNQ is good. AMT is good. Okay, so this is what I would do personally. If you're brand new to dividend investing, I would make VNQ, this is my opinion, make VNQ the largest holding in this slice and these others a smaller slice. I believe that we can't always pick the winners, right? And with VNQ, it's a much easier and safer bet, in my opinion, or a conservative bet, because we don't know what real estate is going to be around and what it's going to look like in 20 years. So that is why I personally would have VNQ higher. And once again, I would lower real estate. I would lower it, or I would put it, in your Roth IRA. So that's my opinion there. I'm not a big fan of the retail REITs here for a 20-year time horizon. You can get growth in other REITs. I like industrials, I like data centers, and I like cell towers when it comes to REITs. So growth, you got Tesla, Facebook, Amazon, Google, Salesforce, and Netflix. You can average down in a Netflix 20% lower now. Wow. Upwork, Alibaba, and Adobe. These are all great growth stocks. I like them. I think averaging into them in the next 20 years, I think it's fine. I think it's a great strategy. You're you're getting exposure to value and growth in one portfolio. I don't mind it at all. Technology, Apple, Visa, and Microsoft. If you're going to hold individual companies in technology, I think these are the ones to go with a dividend focus. I really like these. If you've seen Nvidia drop 50%, maybe even consider picking up some Nvidia. I got called out last video. I say Nvidia wrong. Nvidia. But that's one you could take a look at if it pulls back here. Energy, what do you got? Chevron, ExxonMobil, EPD. I personally, man, this is just my opinion. I don't like this. I don't like it. Even if you're reinvesting the dividends, I like that you have Tesla as a hedge, but personally, why? Why 7%? You can get a higher yield in other sectors that have a future, and I personally, would consider other alternatives to this. Healthcare, what do you got? Johnson & Johnson, AbbVie, Pfizer. Yeah, great. I mean, I like AbbVie much better. Has just around a 4% dividend yield. It's a little bit pricey right now. If you could get it, right around that 100 range, it'd be really attractive. But I like AbbVie much better than, energy stocks. Communications, Verizon, AT&T. Okay, that's fine. Banking, JP Morgan, T. Rowe, Bank of America. Yeah, that's also fine. I mean, you may want to even consider focusing. Well, yeah, you got T. Rowe in here. T. Rowe is really the growth. But JP Morgan is also growing like crazy. So I think it's fine. Procter & Gamble, Kimberly-Clark, there you go. What about Pepsi? What about Costco? What about Target? Are these in here? There they are. Oh my gosh, Costco, Pepsi. You don't have Target, but yeah, this is great. I personally, like I said, I would put these much higher. I bring energy down. I bring these two up. And I would really have these much higher because you're probably consumers of these brands. And you got McDonald's and Home Depot. Yeah, man. So my opinion, bring down the energy, bring down the real estate and bump up these three slices right here. In my opinion, these three slices should be some of your largest holdings. Yeah, utilities, Duke, Southern, and Nextra Energy. Wonderful. All right, so Jordan, you have all the fundamentals. You have everything that you need to be successful. This portfolio is great. I really like it. Now what it comes down to, you mentioned that you're in a similar situation, you and your wife, as my wife and I. Now it comes down to really trying to understand what is your goal and understand that, 31 years old, things are going to change. Priorities in their life are going to change, whether it be with family, whatever. Be flexible. But really, at this point, at 31 years old, it's all about how do you make more money. Right now, how do you, side hustle? Can you buy a rental property? Can you buy a duplex, live in one side and rent out the other side? How can you generate more income so that you can turbocharge your returns so that you can retire in your 40s? Maybe you don't fully retire. Maybe you are financially independent at 40, and then maybe you change careers. Maybe you go and follow another passion of yours. But hey, Jordan, thank you so much for sending over your portfolio. It's so great to hear that there's other like-minded investors like my wife and I out there. So thank you very much. All right, the next portfolio is from Christophe. He writes, "Hi, my name is Christophe, and I'm investing for about a year now. I settled into dividend investing or dividend growth strategy because this seemed the most fun to me with a lot of chances for achieving good gains. I live in Belgium, and the tax here on dividends is 30% in addition to the taxes of the country of origin, so the international tax. Yikes, that is massive. This makes the strategy a little less profitable than in most other countries, but I believe with the right choice of stocks with a good yield and dividend growth, I still outperform most accumulating dividend ETFs. What are your thoughts on this? I invest for the long term, 20 years plus, and my goal is to be financially independent. My portfolio is split between 25% European and 75% US stocks. You'll briefly explain the European stocks. So you got some European REITs, insurance companies, both in France and in Belgium. Wow, man, 30% dividend tax, that is massive. So every country is a little bit different. That's huge. But I remember when I was living in Germany, I think I had a tax rate of like 42%. But that was like all in. That was with healthcare. That was with like everything all combined. But still, nonetheless, like that's, you guys, I mean, we complain about taxes here in the US. I mean, rightfully so if you're in California or New York, but for other states in the US, it's reasonably affordable. But 30%, man, wow. Okay, so let's take a look at this, what you got here. So you have your sectors broken down. I like that you don't have overexposure to one individual sector. You got 15% in tech. That's great. You have a 20-year time horizon. Oil. Okay, oil. Emotional damage. When I see that you got like 10% in oil, I get emotional damage. Oh my gosh. I mean, for the short term, yeah, I mean, short term's all relative. I don't know. I think, if you're just starting to build your portfolio, why? Why would you invest into an industry that is on a reversal? I think in the short term, oil is doing amazing, but I don't know. Everyone to their own, but something to consider. I mean, especially if you're just starting out now. I mean, I could understand if you've been investing for 30 years, like my dad, and like 50% of his portfolio is in oil and he's too stubborn to sell it. But if you're just starting out your portfolio, pick sectors, pick businesses that you believe in and you feel, align with your principles and, who you are and, something that you're passionate about. They have good fundamentals. You believe in the business, yada, yada, yada. All right. So let's take a look at what you got here. A lot of these I'm not going to be familiar with. Some of them I will be. You got the Apples, you got American Waterworks. If I'm not mistaken, AWK has the longest track record of dividend growth out of any company in the world. I think with Altria Group, it's right up there with 64 plus years, I think. You got the AbbVie, 3Ms, Chevron, okay, Cisco, Coca-Cola, Lockheed Martin. All right, so you got IBM in here. You got Microsoft as well. You got Exxon and Chevron. You got Coca-Cola. You got AT&T. You got 3M. All right, you're skewed more towards current income. You're not as skewed heavily into growth, although you do have Apple and Microsoft, for example, and you have Disney as well. So you do have some really good growth in here. So it does balance it out. With a 20-year time horizon, I would skew it. Like, what percentage do you have, for example, in IBM? You got 3% in IBM and you got 4%. Or a target of 4%. Okay, so you got the targets right. I mean, you could even skew this a little bit more. I would have a little bit more in Microsoft, a little bit less in IBM, a little bit more in Apple, less in AT&T, 5%. I'm sure you were not feeling very happy when they cut their, with the spinoff, they're going to be lowering their dividend there. But yeah, so my opinion here is optimize for tax efficiency. Obviously, if you're in Europe and you're subject to a high tax rate, understand the growth rate. Just because a company has been increasing its dividend for forever, it doesn't mean that it's necessarily the right investment for you, or you should be overweighted in that company. Okay, something to understand. Really, when you're at that stage where you have 20 plus years before you look to live off of the dividend income, focus on growth and truly understand compound rates. And that is how, understand your goal, understand really what you're trying to do. And then once you understand what you're trying to do, use the math, use the compound rate to help get you to where you want to be. I always say this, you have your goal, your portfolio is the vehicle, and you need to make sure that you pick the right vehicle for the right terrain that you're going to be in so that the vehicle gets you to where you want to be. All right, thank you so much for sending over your portfolio. All right, the next portfolio is from Keshav, who writes, hello, I hope you're staying safe and doing well. I'm 19 years old. I'm a 19-year-old full-time student and have been investing for about 18 months. Wow. I only have about 12K yeah, you're 19 and you only have 12K invested. Wow. But once I graduate from college, I'll be able to invest $1,000 a month. I want to be able to grow the portfolio as much as possible while reinvesting the dividends. I know my portfolio seems to be concentrated and maybe even risky, but I believe that owning what you understand and believe in is key. Oh, I love it. I love it. Once I build a larger portfolio, I'll be able to sell cash secured puts and cover calls for premium and just keep reinvesting. I used to own 10% bonds, but when the pandemic hit, I sold out and bought into Apple. Got super lucky. Thank you so much for your thoughts. What I want to accomplish is in 20 years from now, you want to have a figure portfolio and retire at the age of 40, if not earlier. Wow. Okay, so I think you're definitely on your path. You have 20 years to go. You're already in, once you graduate, you're going to invest $1,000 a month. Man, that is incredible. So you probably still live at home, or maybe you live in a dorm, or you are house hacking or something. Or you're maybe like an engineer, or you're really getting paid a high salary. This is so cool. If you're looking to do cash secured puts or covered calls, you're not going to be able to do that in M1 Finance. You're going to need another brokerage to do that. It's a lot of work. I mean, cash secured puts, covered calls, it can work very well. I personally like, NUSI and JEPI, for example, and those ETFs do it for me. But if you're into that, I think it's a great way to generate passive income. All right, let's take a look at your portfolio. You are up over 200%, my man. This is so cool. Over 200%, and even despite this big dip that we've seen in the portfolio. Zero expense ratio, so you have no ETFs. You have a good dividend yield. Like, this is actually really good. 200%, a 2% dividend yield, 19 holdings. This is really good. So you got most in technology. Normally I try to say no more than 25% in a single sector, but if you do have a long-term time horizon, like 33%, okay, I can see it happening. All right, so you got technology at 33, you got Apple, Microsoft, and Visa. I personally do not like so much exposure to Apple. Let's see this. You got 33 times 55. 18% of your portfolio is in Apple. For me personally, that is a bit risky. I personally would not have 18% in one individual company. It's too risky for me. What if something happens to Apple outside of Apple's control? Like, I don't want to retire early and have so much exposure into one business. And if something happens, that means all of my plans are destroyed. Like, I'm a lot more conservative when it comes to that. You're 19 years old, you have 20 years, you have plenty of time to evolve that percentage over time. Real estate, what do you got in here? Realty Income, Store, and American Tower. I like this and I don't like this. Realty Income should be the lowest. American Tower is great. Stores is great. These are two retail REITs. I personally would lower Realty Income, and I would maybe get a data center. Although AMT, they just bought a data center. So AMT is a cell tower and a data center REIT. And so this is a very well diversified REIT. This is probably my favorite REIT right now, this and Prologis. But I would lower Realty Income, and I would look at maybe something like Prologis or maybe a Stag or something like that. I would put this maybe down to like 10% and focus more on growth. And I would lower real estate, especially if this is in a taxable account. I would lower this to maybe 5%. Maximum 10%. If it's 10%, lower Realty Income like a lot, because there's no need to have that unnecessary tax burden. Just not worth it. Consumer, you got Pepsi, Disney, Costco, Coca-Cola. I really like this. I like Pepsi higher than Coca-Cola. I like Disney. I like Costco. I like it a lot. Healthcare, United Healthcare, Johnson & Johnson. These are both really good. You see this, like, man, this is really good. I also like AbbVie. I like Medtronic, and I like Stryker. Those are other really good healthcare companies, in my opinion. Financials, JP Morgan and T. Rowe. This is great. You could also look at SPGI, but you could even look at a few insurance companies, but I think it's good. Industrials, Waste Management, love it. Honeywell is also good. I like Caterpillar as well as growth. I like Union Pacific, but yeah, Waste Management and Honeywell, these are good. Telecom, nope, don't like this. I don't like AT&T. I mean, you could keep it, lower it like 60%. No, it's now with the spinoff of their Warner business, it's just a telecom. It's just a telecom company. They're going back to their roots. It's not a growth company. And so I like Comcast much better than AT&T with the 20-year time horizon. Growth stocks, you got Tesla. Go for it. Wonderful. Well, Kesh, thank you so much, man. This is cool. I like what you're doing here, where you're mixing the growth and the income, and you're getting great performance when it comes to the overall performance. But in my opinion, I think you could even maybe do a little bit better in terms of the growth that the portfolio will yield you by altering your real estate. So in my opinion, the biggest opportunity for you is to reassess your real estate portfolio and your telecom. Telecom and real estate, the rest are great. I think, yeah, thank you so much for sending over your portfolio. All right, the last portfolio is from Jamal. He writes, "Hello, Jake. I'm a new subscriber to the channel and been binge watching most of your videos and truly enjoy the content. So thank you. Thank you so much, Jamal. I appreciate it. I'm new to investing and would like your input on my pie and plans for it for future generations. I love if you could review it on your channel, as hopefully it will bring inspiration to other fathers who are getting a late start in investing, but would like to add the legacy, financially speaking, to be left for a family's future generations. I have a 401k for retirement. So this portfolio is for wealth building exclusively. So wealth building, you're probably planning on leaving this for your family, which is really great. You're 42 years old. What are your goals? So build a simple, so emphasis I think on simple, portfolio in an after-tax brokerage account of no more than 15 stocks and ETFs, which has a mix of growth and dividend producing holdings covering all sectors of the US and international markets. I plan to contribute $100 monthly to it for the rest of my life and leave it to my children when I pass for them to use the income produced by the portfolio as a secondary source of income, as well as provide a firm financial base. When my two children are of working age, about 8 years from now, I'll introduce them to investing by duplicating this pie in a brokerage account in their names, go over the holdings and encourage them to tweak it as they learn and contribute a portion of their earnings monthly to their pies for their lifetime and to do the same for their children. By having these portfolios at an early age, they will have financial stability, allowing them to make choices without the concern of money." Jamal, there's so many things that you say in here that resonate with me. I mean, for those of you that know my story, like I didn't, grow up with a silver spoon, right? And it doesn't sound like you did either. But you want to make sure that your children are in a better financial situation than maybe you were, or your parents or your grandparents. I think this is so great. Some of the things you talk about here, build a simple portfolio. It doesn't have to be complex. And I think probably the thing that I like the most about this email here is the very last sentence. By having these portfolios at an early age, talking about for your kids, they will have financial stability, allowing them to make choices without the concern of money. I think that's really embodies everything that I'm talking about on the channel. It's about financial freedom. It's about not having to worry and make all of your life decisions based off of the holy dollar, the holy euro, the holy peso, the holy whatever, money, and really enjoy life on your terms and not maybe on somebody else's. So I think this is so great. All right, Jamal, let's take a look at your portfolio. Your portfolio is up 81%. We didn't necessarily talk about time horizon. So my understanding is this is going to be a portfolio for you to first use when you're retired that you plan on then handing down to your kids, which will then continue to compound over time. So you have a healthy dividend yield. This is an account that you would be using after the age of 59 and a half. And so if you're 45, okay, so you got a good about 14 years or so before you would be using the money in this portfolio. You have a good handful of ETFs and individual companies. I like the fact that a lot of these companies just off the bat are well-known companies. These are probably companies that you visit on maybe a weekly or monthly basis, right? You probably have a subscription to Disney Plus. You probably enjoy a Starbucks coffee on the way to work. You probably get an Egg McMuffin from McDonald's on the way to work. You probably have a house or something that you're remodeling and you go to Home Depot. These are brands that you're familiar with, and I really, really like this. So let's take a look at your first holding. 25% is in VNQ. That's a large amount to have in VNQ. Now, I don't know what's in your 401k. I would assume what's in your 401k is more like the S&P 500 or something. But right off the bat, 25% is a little bit higher, but I don't hate it. I think it's okay. I do like VOO. I mean, maybe what you could consider doing, consider breaking up VNQ and adding maybe SCHD or VYM, right? Because you're focused here on the high dividend, right? And exposure to real estate. So why not consider maybe making this 15 and then adding another 10% to VYM. VYM is the high dividend ETF from Vanguard. And so that's something that I would maybe consider, okay? And so you got the S&P 500, Disney, Starbucks. You have a corporate international bond. That is interesting. I'm not the biggest fan of bonds. If I were to get a bond, I don't know if I would get an international bond. My favorite bond is BND. So you have BNDI as well for international. That's just, my personal preference. VEA is a really good international ETF. I have VXUS, but VEA is also really, really good. I don't think you can go wrong with either. McDonald's, great. Home Depot, great. So you have a lot of growth here. You have the growth in McDonald's and Home Depot. You have the current income in Coca-Cola and AT&T. Duke is kind of a hybrid of growth and current income. You got Apple and Microsoft. And you have another treasury bond here. I overlooked that one. I actually kind of like this. I like that it's simple. It's something that's manageable. It's something that you can set up and forget. The only thing that I would consider reconsidering with this portfolio, there's only two things. One is what I already mentioned about with VNQ. Maybe reconsidering that, or considering breaking that up and adding VYM, or maybe another ETF, a higher yielding ETF if you'd like. And then the other thing is the bonds. You have 10% in bonds. The thing that you have to understand in most cases with bonds over the long term, bonds are to preserve wealth. Bonds are not, and every economic cycle is different, right? In the economy, I think in the short term, bonds are going to continue to do well with, everything that's going on in the world. But when I think of bonds, it's about preserving wealth. And right now, you're 45 years old, you're trying to accumulate wealth. That's why I like focusing more on equities and not necessarily bonds. But if you are going to keep bonds in the portfolio, I like that you minimized it to only 10%. So there is that. Jamal, I really think this is great. I think it's amazing what you're doing, and the reason or the background or your motivation behind why you're doing this. I think it's really, really great. And I'm sure a lot of people watching this video probably can relate with you and probably get inspired by what you wrote as well. Thank you so much for sending over your portfolio. Thank you so much for watching, everybody. I can hardly believe that this is the 30th Review My Pie that we've done here on the channel. Thank you so much to everyone that has sent in their portfolio. Thank you so much for everyone that has been following the channel. I hope that you got value out of today's video, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.